So, how are you, not just mid-caps, more generally, how are you approaching the market? You think this distress, by its very nature, would be a passing one, and therefore you will stock up more?
No, we've not really, tried to incorporate what's happening with the coronavirus and, likely slowdown in growth. Because there's no way to honestly, Lata, do that in terms of figuring out who's impacted and who's not. I think the best protection against that is just the fact that we run reasonably well-diversified portfolios. None of the companies is excessively leveraged. Of course, there could be some growth slowdown for some companies. Maybe a few companies in our portfolio will suffer. Hopefully, a few other companies will do well, and on balance, we'll do okay. And that's the reason why we run, diversified portfolios in the first place. So we're not trying to sort of use this as a reason to, buy into certain stocks and exit certain stocks. I wish I was smart enough to figure that out in terms of what to exit and when to buy it back. But, I don't think that's our core. And, hopefully some of these companies in our portfolio, those managements are on the job of trying to figure out what they can do to manage some of the risk, though I don't think they can completely insulate themselves from this.
Okay, well, for now, there's big buying seen in the mid-cap index, up 140 points on the index itself, and there's so many stocks hitting new highs. Muthoot Finance is at a fresh high. Trent, ever since it came out with its numbers, has been soaring. In fact, Trent is now up 50% this year at a fresh high, and PVR is the other one that's looking pretty good. Vetri, hi, good morning. So, back home, have you seen any pickup in consumption? And do you think that pickup could get stalled because of several issues? I mean, if you just talk about autos particularly, there was some signs of a recovery, but now this whole coronavirus scare will disrupt supply of auto components. So do you think that there is one space that you would continue to stay away from?
Yeah, morning. If you actually look at, the commentary we were getting from companies as the earnings season played out, I would say it remained fairly mixed. There wasn't really anybody talking about a significant, improvement in demand. Having said that, I think what we also picked up during the earnings season is that most companies had, done a good job of running down their inventory, and therefore the sort of pipeline is running fairly thin at this point of time, which sets you up reasonably well for, just restocking-led demand to sort of improve things. But yes, now we've got this supply-side disruption coming in, which is essentially the coronavirus impact on global supply chains, and therefore to that extent, neither the commentary nor this event really make us feel more incrementally positive about the outlook for demand as a result of both the inputs we are getting and what's happening on the ground. I think one will just have to be patient for that. But even before the coronavirus episode, I think it was pretty clear that there was no magic bullet to sort of a growth bounce back domestically. So I think we'll just have to continue remaining patient as far as the growth recovery is concerned.
Okay, by the way, lever is now up 2.5%, so that's again approaching an all-time high. And that's been one space which, or one stock which has been really the titan of this market for some time now. Vetri, that's the million-dollar question then. I know you won't talk stocks, but names like Lever have been all-season stocks for last 4 years now. You think that kind of trend would continue? People buying quality at whatever price?
Well, Anuj, if you've been as long as I have in the market, that you'll know that cycles change. And I think if we go back about, to maybe 2011 or 12, you could have, inverted this entirely to talk about that same stock and say, why is it so unloved? So there are cycles. The only challenge is that you don't know how long the cycle will run. But, I think in the medium to long term, these cycles do keep playing out. You see them both in the profitability cycle as well as you see them in the, the way the PE multiple behaves. And remember, there's nothing scientific about a PE multiple. In some level, all it reflects is what, sort of popular sentiment is willing to pay for the same rupee of earnings. And that can fluctuate quite wildly. So, I would tend to believe that, just quality at any price or any valuations can prove to be a slightly dangerous strategy as and when the cycle starts to normalize a little. So I would tend to be a bit wary of congregating excessively in some of these high PE companies. Sure, they have great growth runways, but I think what you need to manage, and it's not necessarily a binary choice, but I think you need to sort of figure out how you want to manage your overall portfolio risk and position size in some of these companies where the long-term growth may remain attractive. But if you look at the last 10 years in terms of delivered growth and presume that the company can repeat it, are you still able to justify the company's current valuations? Not specifically referring to Unilever, but I'm saying that's the broad principle you need to apply.
Okay. Well, so what do you do at a time like this in terms of asset allocation? Is this a good time to be raising your allocation towards safe haven assets like gold? I mean, gold has already hit new highs, but do you think that this risk aversion in equities could lead to more money moving outside of it?
So, the way I've always looked at gold is that it's a little bit of an insurance policy, but the time to buy the insurance policy is when it's going cheap and nobody feels the need to get insurance. I think now you're in that mood where, everybody seems to want insurance and it's the best performing asset class. So it's not clear to me that you want to buy insurance when it's already becoming one of the best performing asset classes. But, I'm not an expert on that, but, that's the framework that at least I would bring to the problem. From asset allocation point of view, if you look at aggregate valuations of equities on PE, price to book, it's a fairly mixed outcome at this point of time. It's not outrageously expensive on an aggregate level, but neither is it bargain basement cheap. We run some internal asset allocation models which actually feed into one particular strategy that we run, and it is still indicating very conservative asset allocations in the region of about 42-43% out of a potential which could be anywhere between 40 to 80. So that tells you that the model is not still particularly excited in terms of where it wants to position in terms of asset allocation right now.
Okay, Vetri, what is your broader view on earnings growth itself? I mean, do you cling to the kind of green shoots we saw in some of the stocks in the third quarter? I mean, there was always a standout performance from an HDFC Bank or some of the consumer companies like, say, Trent or Bata. Do you cling on to that, or do you think that we are going to continue to see lower earnings growth either because of coronavirus or because states don't have money, governments are not spending? How are you looking at the earnings growth trajectory?
Well, you could argue, Latha, that the market's already looking at that, right? Which is why you've got a market which is, as I said, it's certainly not cheap, it's not ridiculously expensive, but trading in the upper ranges of, fair valuations, just short of being richly priced. And it's looking at the fact that Nifty consensus EPS growth for FY21 is running at almost about 24-25%. But I still think that's a pretty narrow number in terms of what it is being driven by. It's been driven a lot by the financials. Little bit of lagged impact of the tax cut change, though a lot of the tax impact has come in FY20 itself, but it's still a narrow set of companies which are driving that high 24-25% number. And to that extent, I would have to worry that the risk, if anything, to that EPS number is still in terms of a risk to the downside rather than an upside risk. But remember that, you have to presume that the market already knows that we are looking at a 24-25% EPS growth, because that is the consensus, and it's hard to argue that the market is not aware of that.
Vetri, we'll leave it there today. Thanks a lot for joining us. Always good talking to you. But that's the view from UTI Mutual Fund. The market's still a bit vulnerable, holding lows, but as you can see, most rallies are getting sold into. So you had that one rally which played out. The first gap up got sold into. After that, there was one more rally. Now that's also beginning to peter off a bit. IndusInd Bank is now a stock which is putting some pressure on the bank Nifty. And of course, HDFC Bank and ICICI Bank have been weak. So, yeah, there it is, IndusInd Bank now moving into the red. So, a bit murky all over the place, but let's see. As of now, holding yesterday's low.
Okay, as of now, holding yesterday's low. So, gives us some time to look at other issues. Shree Cements is a stock that will be included into the Nifty from the 27th of March. To get a sense of the cement demand and pricing trends, We now speak with H.M. Bangur, who's the MD of Shree Cements, who joins us now. In fact, the stock is up 65% in the past 1 year and 30% in the past 2 months itself. So pretty strong there. Mr. Bangur, good morning and thanks for joining us. I wanted your view on how the next 2 quarters will shape up. Given the fact that price hikes have resumed, should we expect better margins than what we've seen in the preceding quarters?
In the cement industry, price rise is very, I will say, place to place it changes and time to time it changes. But overall, if we see the last 10 years trend, it will be around 3 to 4% price rise. So the price rise, any long-term player who wants to enter the cement industry must understand that the price rise is not an unknown factor. It will be around 4% every year, year on year. That is all. That has been the trend for last 30 years. So sometime price rise in some market for 1 month is not a big news for any, I will say, investor. It is a big news for newspapers and media. That's all. It has nothing else to do with the profitability. Now, the demand is one other factor which is very important. So, right now we are very bullish that government has announced a very good more than 1 lakh crore for infrastructure projects. Some of the demand from last 1 month, we are seeing that the demand upside is there. It has really become visible. It is not as bad as it was earlier.
Okay. Well, good morning, Mr. Bangur. That is exactly what I wanted to hear. Can you give us a little more color on demand? We get rival views. One, that governments are still not spending. State governments have got less money from the tax kitty which they share with the centre. So the expenditure could well be less. What do you see in terms of actual projects on the ground? What do you see in terms of demand from rural housing, for instance?
We feel that from January onwards, for last 1 month, the demand has suddenly picked up. Maybe because of weather conditions, more working hours are there to be cement to be consumed. In the peak winter, it is only 6 hours is the working time. Now it is become 8 to 10 hours. And in the February and March, because the bitterness of cold has come down, day hours are more, and we feel definitely better about the cement demand. Now, two things are there. One is government spending, which is also not bad. Whatever others may be feeling, it is their feel. But the other part is the individual house builders. So, very good amount of spending is being done by individuals. They are having money, they are having aspirations. And the combination of aspiration and money means cement demand.
Okay, so that's good to hear, Mr. Bangur, that the government is spending and you're getting higher spending from the private sector as well, from individuals that is. So can you give us some numbers in terms of volume growth? I mean, what could the volume growth look like by the end of the year? And what are you penciling in the first half of FY21 for the industry and for Shree Cement?
Shree Cement will be growing at par with the industry now as far as volume growth is there. And I expect in the next 6 months, the volume growth will be 7% or so. About 6 to 7% volume growth is expected.
Okay, Mr. Bangur, HUL has thrown a new expectation on everybody's mind. They have created a subsidiary which we assume is the place where new expansions will happen so that they can take advantage of the tax, of the lower tax. Will you do anything like that?
No, we will not be doing anything like that, because that means a totally new set and new working. And even if a new factory is put in the same company, the new advantage will not be given. So we will stay with the old company, one company, and doing the same thing. But the new units will definitely be put at a faster pace in the new company.
All right. Mr.
in the
Bahadur,
same company. Sorry.
Okay.
We'll leave it there, sir. Thanks a lot for joining us. That Shree Cement will be part of the Nifty has been a remarkable stock over the last 1 decade or so. But let's move on then. Biocon is down about 4%, though, you know, it